Why aren't homes selling today? Why are homes sitting? It's a question I'm getting from a lot of sellers that I'm working with today. And where in the world are all the buyers? So today has been an office day. I'm not even gussied up to make this video because I wanted to get this information to you hot and fresh as I'm reviewing it while my mind is clear and I have my train of thought. And I want to answer that question because I'm reviewing some data. I'm sending reports to seller clients that I'm working with right now to answer some of those very questions. And rather than give platitudes about how, well, we just need to drop the price, let's have an understanding of what in the heck is actually going on out there right now because it's more nuanced than you think. And I think there's opportunity here for sellers and buyers to work together. So what I'm about to show you in this video is a lot of data. We're going to talk a lot of numbers, and we're going to talk about how we're going to leverage that in strategy if you're either selling your home or you want to make a purchase. So buyers and sellers, this information is important to both of you. So I'm going to break down a few things for you today. We're going to talk about the Affordability Index in the Portland, Oregon metro area and why that is so important to us today with what we're looking at in the real estate market here. We're going to talk about what the price is and for a $500,000 house, what you're going to pay every month for that as it stands right now with today's average mortgage rate. Then we're going to talk about how do we make prices fit that affordability index that people can afford today. So that is where the strategy is going to come in so buyers understand on a greater scale how they might be able to make things fit, and sellers, you have an understanding of what buyers are facing, because honestly, without buyers, sellers, without those buyers being able to afford your house, they're not going to buy it. They're not going to be out shopping. So we need to really work together and figure out how we get past this stage of the market so that we have everybody achieve the goal. And sellers, you want to sell that house. So let's get into it, shall we? So for some context here, let's start by looking at this market action report. This report just came out. It is for July of 2025. And really what that means is it is August. This data that we get from the RMLS always trends a month behind. So we get the data from the month of July, and we kind of use that to make some assertions about what the market is doing today. So this is the July 2025 reporting period, and it gives us a lot of data. We're really not going to spend any time on this because there's only a couple things I want to talk about. There's a few things for context I want to point out. We're going to look at this average sale price, the median sale price, total market time, break that down just so we have an idea going into this conversation of what things are looking like. These numbers are pulled from 5 counties, Columbia, Washington, Multnomah, Yamhill, and Clackamas counties. That's making up this Portland metro residential highlights information that we're seeing here. So average median prices are pulling from obviously prices across the board, the lowest price homes and properties all the way up to the multi-million-dollar estates and everything in between. So average and median aren't always necessarily, they're not perfect answers, but they give us good ideas. So our average sale price in July of 2025 is coming in at $621,800. If we go down a couple lines to July of 2024, it was $622,900. So that means we're actually down 0.2% over our average sale price as of July of last year, comparing year to year. Our median sale price, little different territory. If we look at July 2025, it is $555 exactly. If we go to July of 2024, it was $550. So we're actually up 0.9% over last year. Here's something interesting that I'll point out. Our total market time is coming in right now at 52 days. That means it's taking about 52 days for homes in this Portland metro region to sell in that 5-county area. Last year it was at 44 days. So time on market is up year over year. Okay, so now that we have that context, let's dig into some interesting graphs and charts. Don't want to bore you to tears with data, but here's what I think is really, really interesting. Our active residential listings right here is what is currently active on the market. And you can see this orange line represents 2025. That number, there's some space. They've I think Logan Motoshami of Housing Wire describes these types of things as a slow dance over time. And we've got some space left for the Lord here in between with this inventory amount between 2024 and 2025. We have more active residential listings this year than we saw last year and certainly in 2023. So the numbers are down here. Right now, as of July, we're looking at around 7,100 or so active listings. And then last year, by the same time, we had, July, 7,500 active listings roughly. And last year, same period of time, was around 5,900 active listings. So we have quite a bit more, not quite 2,000 more active listings in the Portland metro region this year versus last year. So buyers, that means you have a lot more inventory and choices to think about. And here's where that also starts to get interesting. Our pending sales. So that means a home that was on the market, they've accepted an offer, they're under contract, they're working on the process of closing. Our pending sales have been right in line. I mean, look at that. That's a terrible line. My apologies. Look at this orange line that's kind of stuck in there with the 2023-2024 line. We're basically experiencing the same amount of sales that we saw over the last 2 years, maybe slightly less in some months than as we did during 2024 and 2023. But yet we have more, let me scroll back up here, active residential listings with the same general amount of sales that we saw over the last 2 years. That is pointing to the fact that buyers have a lot more choices, a lot more inventory, a lot more houses to choose from. They can be more particular about what they're looking for. So then if we get to our closed sales, kind of the same position here. The closings are actually looking like they're less than 2024. Closings are down over the last few months, but it's in kind of a dance with the last couple years of data. Our closed sales trending similarly to the last couple years with the added layer of more inventory. So the same amount of business is happening, but more choices. All right, so if we continue scrolling down here, we're going to look at, now this is where we're going to get into something, I think it's another interesting. So up here we looked at, just keep scrolling back and forth. We have active residential listings up here. The next graph, which is impactful, slightly different way to look at this data. This is total active listings, okay? Again, we see some space here between 2025 and 2024. There's a gap. That means and it's pretty significant. These numbers here, what we see in this little July piece here, is in 2023, we had around 5,700, well, trending towards 5,800 total active listings in July of 23. Compare that to today. I wouldn't be surprised if honestly we're trending towards having double the amount of inventory on the market as we saw in July of 2023, and seeing that continue. That's kind of a prediction I'm going to make here with this data we're looking at. Is there's a very good chance that as homes are staying on the market longer and fewer buyers are entering the market to buy, we're going to start to see inventory numbers increase to where we have double the inventory we saw just 2 years ago. That's my prediction. So how is this funneling down into what sellers are going to experience? Other than sellers, you've got more competition. Buyers are going to be more scrutinizing and more particular. So for a number of reasons, you're going to have to be on your A game. And that is not just with pricing, but with curb appeal and with marketing and all of those things to make your home stand out, because we actually have competition now. It's not as simple as throw a sign in the yard and that thing's going to sell in a weekend. That does still happen, but it is more rare today than it was, let's say, back in 2021. And honestly, the data doesn't lie. So that is just some anecdotal pieces there. So what does this mean? How else is this let's check in the world of buyers. How else is this funneling into everything? We're going to look at this, and this video really discusses, so we've seen all this context. We know the background of the market. We've seen what's going on, that we have more inventory. For buyers, generally speaking, that is great. We need more balance. Buyers need more to look at. We need more options. We've been saying this for the last several years. Buyers need more inventory. I can't find anything that fits my needs. What am I going to do? I can't find a house that's going to work for us. We're starting to see that inventory come to the market, but here's the challenge, sellers and buyers. It's this, the Affordability Index. So what this does is it takes the HUD median income, and that is in the fine print down here, $124,100 in 2025. And again, that is per Housing and Urban Development, or HUD. So when we look at this history back to, let's say, 2019, 2020, early here, we can see it's kind of around 120, maybe 125% into the December of 2020. And they look at this, it looks like it's on a quarterly basis, so December to March. So Q4, Q1, Q2, so on and so forth. It was between 120, maybe 125-ish, maybe 130. That means that a buyer back in 2019 and 2020 could afford 120 to 130% of a mortgage payment with their median priced income for a median priced home. And so that's, let's say, $570,000 as of June. And that's what this is saying right here. So compare that to today. It's not quite, it's kind of a grim figure to look at because it's down significantly. The affordability right now, the index is coming in at just 87%. That means that today, the person or the family with the median income of $124,100 can only afford 87% of a monthly mortgage payment on a median priced home in this market. And again, this formula is assuming 20% down and a 30-year fixed with a rate of 6.8%. Not at 20% down. If I'm going to educate anybody on this, not everybody's going to have 20% down. There are loan programs out there, folks, that enable you to buy a home that don't require 20% down. There's, FHA loans that are 3 or 3.5%. You've got conventional loans that are a minimum down payment of 5%. So there are options. So you're not just funneled into 20% down if this is a goal that you have. But the reason I think that this is so important to talk about is sellers. This is what your buyers are experiencing right now. There's a whole group of people out there in our market today who want to buy a house, but they just cannot do it. They can't make it happen because they can only afford 87%. $124,000 seems like a good income. Once upon a time, that felt like you were making good money. You could really support a family with that type of income. But right now, if they can only afford 87% of a mortgage payment to buy today's houses, that's going to make it really hard for them to be able to buy your house, especially as we start looking at higher price properties and it gets to be more competitive on those lower price points. So buyers out there, your pain is legitimate. The pain you've talked about where, how can I afford this? What do I do? I want nothing more than to buy a house, but I just can't do it. These mortgage numbers are scary. It's mind-boggling. It makes me nervous. And rightfully so. These numbers don't lie. These numbers put data to that feeling you have of the things that are pulling on your wallet right now. So that is this information. So keep that in mind because this is going to basically paint what we're going to look at moving forward. So if we take a look at some properties, what's out there on the market right now in, let's just call it 475 to 575. So we know that median income earner at $124,100 could afford 87% of a mortgage payment on a house that was at median price point of around $570,000. So what is in the area for sale that fits that for the most part? There's lots of choices here. So if we just want to narrow in and see what's out here, let's look at this little section here that's Wilsonville, Canby, kind of some Oregon City here. There's plenty of choices here. You've got some different options like this guy's 550, 5 beds, 2.5 baths. The 2.1 means half. The 0.1 means half. I don't know who made that rule, but that's what it is. So you have some things that are, under 570. This one is 499, 3 beds, 1 bath. In Wilsonville, there's some options. This one is 570 roughly, 3 beds, 2.5 baths. So there's things out there on the market, but what does a payment look like? Let's say we just picked any random one of these at a random price. What is that payment actually going to shake out to be if you're going to buy that house? Let's calculate that, because I think that's what's going to be really eye-opening. So here's a mortgage calculator website, mortgagecalculator.org. You could go play with this. It was just one that showed up on Google, and I used it because anybody could access it. They could go there and play with these numbers themselves. It's nothing proprietary. It's just here. It's something you can use. So I know that they talked about the median price point of 570. But most people, let's say they're pre-approved, they worked with a lender, they got a pre-approval, they said they could buy up to 570, 575, but maybe they just don't want to do that. Maybe that's pushing them a little bit more. Often when I work with buyers, I tell them you're not required to spend your full pre-approval amount. Let's see what we can find that fits your needs, that maybe makes you feel like you're not spending all your pennies every single month. So let's just say it's $500,000. Let's just work with that. It's a round number, $500,000. Seems like there were some options in this area for 500 grand, all over the metro that could be options. So let's just work with that number. Let's just say, so that's our $500,000 right here. And then we're going to assume maybe it's 5% down. Maybe you've got 5%, and we're just going to go with that. Obviously, these numbers will shift a little bit if you are using a first-time home buyer's loan. But again, this is just for estimation purposes, just to show what's possible as potentials. Your individual situation may absolutely vary based on your credit. I'm also not a lender, so I'm only speaking to this from my basic understanding as a real estate agent, and how I have conversations with my buyer clients when we are putting these things together. So that means your loan amount would be around $475,000. So today's mortgage rates, hold on with me one second. Just so you know that I'm not pulling numbers out of the sky. So it's August 7th, 2025. It is recording this right now at 2:00 p.m. Pacific. So the markets have officially closed and have been closed. So today, this is from Mortgage News Daily. You can go to this website yourself and find it. Our 30-year fixed rate average on a national basis today landed at 6.55%. So we're just going to use that number. That may not be the number that you as an individual buyer would receive. Again, it depends on your loan type, your credit, and several other things, and a lender is going to be able to help you with that. But for the purposes of this demonstration, that is the number that we are going to use today. So let's go back to our calculation while we're at it. So right now that rate is coming in 6.55. Okay, so then we're going to put in 30-year loan. It's going to, let's say you get into contract on a property today. So we'll say your loan's going to start next month in September. I don't know what property taxes are. We're going to throw in $4,500. Know that that could be more, that could be less. Really depends on the house and where you buy it. PMI, so mortgage insurance, if you have less than 20% you're putting down, it is required that you pay PMI. So that is going to be put in there. Home insurance could be around $1,500. We just put a number in there. Again, this is one of those things that you have some control over, shopping for a rate that makes sense for you and protecting your home to the best your budget can buy. So that is where I have $1,500 in there. Yours could be more, yours could be less. We're assuming with this demonstration that there is not a monthly HOA. Obviously, that is really going to shift things if you have monthly HOA dues in the case you would find if you had a townhome or a condo or something like that, or even a residential development like Villa Bois in Wilsonville, for instance. There's monthly HOA dues that cover the common areas and such. So we're just going to keep this very straightforward for this demonstration. So if we hit calculate, what is the monthly mortgage amount that you would be paying at $500,000 straight across, 6.55% interest rates with a 30-year note? That payment is over here, $37,1588. That's a shock to a lot of people. It is. It's a lot of money. That's trending. That's on the side as we round up to $4,000 almost. That's a lot of money. I'm not going to be the first to say it. That's a hard pill to swallow for a house that's $500,000. And for a lot of people, when they see $500,000, they say, gee, I would envision something totally different than a 1,600 square foot ranch home built in 1965 that was updated in 1989. And that's our market. And it's hard. It's a tough pill to swallow. So again, that might be what you find out there. So it's kind of this interesting just difference of expectation versus what reality is. And the reality is right now that $3,700 is what your payment would be for a $500,000 loan. And it breaks everything down here. $197.92 is the monthly PMI payment that's part of this $3,700. So without it, you would be at $3,517.96. But again, that's assuming a 5% down. So you would have to refinance or whatever, based on your loan program, whatever that looks like, to get rid of that PMI. So that is what that payment is. So great. What does that mean for the affordability index? Well, the affordability index, so if we take that 87% rule of that right now, that the average or the median household income of 124 grand, they can afford 87% of today's median price. Let's just apply that, maybe not perfectly, but just for the sake of this demonstration, that maybe 87% might very well apply here. What if we applied that to this $500,000 home? What does that look like? So 87% of a $500,000 property, or of this payment, is actually coming in at 33,000. What is it here? It is coming in around $3,223 roughly, or $332. So let's just call it around $3,200 for what that affordability index, if we applied that broad scale. And again, I know that's not perfect math. There's some shifting with the changes, but we're just going to look at this as a way to strategize around how do we make buyers think strategically and sellers think strategically to meet in the middle on a solution that's going to work for everybody. So how do we get to 100 from 87%? Well, that's a 13% difference. And if we want to break even at that 100% where a buyer can afford 100% of that mortgage payment, let's think of how we get there. Is that a 13% decrease in the sale price? That could be a place to go. So what does that look like? If we said, let's take this $500,000 home, perhaps it's been on the market for a little while. Maybe it's been on the market for 100, 120 days. When it went on the market, they were using as their price strategy comparables from back in April, March, February. And if there's one thing we've seen this year is our market has rapidly shifted since the beginning of the year. So for us to say we're going to use those same comps and, think that pricing strategy is still good at 120 days, we're in two different markets. So perhaps that $500,000 home hasn't dropped its price. It's been on the market a long time, and it's using what is now, even though it's not that long ago, a very outdated pricing strategy. So if we take a look at this and say, well, what does it look like to drop 13%? Let's play with those numbers, shall we? Let's see what goes on. So if we drop it around 13%, that takes us down quite a bit. It is a big price reduction, around $435,000. Okay. I don't know if most sellers would be willing to come down to $435,000, but where does this get us in terms of payment, assuming that the interest rate and everything else stays the same? Let's calculate it. Brings us a lot closer to that affordability equation, $3,297. So if we called it $3,300, you could play with this a little bit. Maybe it's $434, and we can kind of see what's going on. Maybe we can get it down $100. As you can see, it takes a lot of price reduction to make a difference here. Let's see what we get there. So you see it, $3,265. So it takes a lot to get to that number. Let's just go back to $435. So we're at $3,297.81 is your monthly payment. The PMI on this one, I'll circle it so you can track it, $3,297.81. And then your PMI is $172.19 in this situation. So this isn't a small difference between the original payment, remember, I'm going to try to write this on here, was $3,715.88. Okay, that was the original payment on this house at $500,000. So that's a difference of $418.07. This is terrible. I wish I had a better way to write this on this screen. $418.07 a month. So that's significant. That's not chump change. That adds up to just over $5,000 a year that you would save if you could factor in that price decrease based on that getting to 100 on an affordability index. So, but let's just say maybe a seller is not willing to drop their price to $435,000 to accommodate where buyers can actually afford a house today, which is possible. It's quite a check to the ego. Maybe that seller has goals and, maybe that's just not going to make sense. How else can we find a way to work with a seller? How else sellers can you negotiate to make something happen where we don't have to necessarily do $65,000 price reduction? So let's take a look at those numbers. Shall we? Let me see if I can find something else to show you. So one option that might make sense is a 2-1 rate buy down. As it says, you could Google this yourself. So I'm showing you something you could do your own research and find. It is a temporary mortgage arrangement where your interest rate is reduced by 2% in the first year. So today it's 6.55. It would be first year 4.55. And then in the second year, it's reduced by 1 point. Or by 1%. So it's not 1 point, by 1%. So it goes to 5.55. And then by year 3, you're back to the full amount of interest rate that you had when you signed your papers. So the interesting thing about this, when I talk to people about it, when I have buyers who are considering this particular arrangement, is you have to qualify for the property at the full rate at the time you were purchasing it. So today, 6.55%. So you have to qualify for that full payment at let's say $500,000, the full price at $3,715.88. You have to qualify for that full mortgage amount every single month in order to qualify for this. So what does it look like if we do a 2-1 buy down on the house when it is $500,000? Okay, so what I've done here is I have a Google sheet that just to put this all on one page, so we're not going back and forth. So this is using that same mortgage calculator that I showed you over here, which you can put these numbers in yourself and play this game too. So that's using this right here. I calculated what that's going to look like if you did a 2-1 buy down. So let me do some more explaining about the 2-1 buy down. So these are all of our criteria that we're looking at. So we're assuming it's a full price, $500,000, 5% down, $4,500 taxes, the same things as before, the first example we talked about. A 2-1 rate buy down does come at a cost. So it's not necessarily something that you have to bring as cash to close, though you certainly can. Most people, in addition to their down payment amount, they're going to want to have the money to pay the other closing costs they need to pay. So usually a 2-1 buy down for a home of this price point is going to cost around $10,000, give or take. Might cost a little bit more, really just all depends. You'll want to check with your lender about that directly. But this is something that buyers and sellers know, that buyers are going to ask for a credit like this to help them buy down their rate. This is going to help them with affordability because it takes, so the 2% in year one is 4.55%. Again, that's based on today's rate of 6.55. That takes that payment to, in year one, $3,118.80. So it drops it below the 32-ish or 32.70, 32 something that meets that affordability index amount, right? In year two, it goes to 3409.83. So it goes up because your interest rate goes to 5.55. So then that is still less money. You're still saving every month. Then by the time you get to year three, you're back to 6.55% and your rate or your payment is $3715.88. Is this the best fit for everybody? Absolutely not. Um, there's some assumptions that come with this program that are cons to this program, and that is that if rates come down, if being the big thing, okay, there's no guarantees. It may not happen. They may not come down very much, where it might be negligible. It really just depends. So don't always assume that rates are going to drop. We don't know. I don't have a magic 8 ball. I don't even have a crystal ball. I don't know. We don't know when it's going to happen. We can't forecast economic events or global leadership and what happens there that impact the economy. There's so much out there we don't see into the future, so we don't know what's going to happen. So it does assume that rates could come down enough where it would make sense for you to refinance to lock in a lower rate and therefore a lower payment to ease things for you. The pro with this, though, is if let's say you can make this payment, great. I would always recommend people who they can afford it, they may not like it. I always say, make this payment every month, even if it's only $31.18.80, because not saying you can put it against your principal balance. That's going to help drive that amount down a lot faster, or you can put it aside in a savings account and enable you to have a nest egg or build up some cash savings for yourself. So either way, you're paying that extra money. I always advise people to do that, just so then you're kind of already used to making that higher payment if rates don't come down. Maybe you're in a position where you have to buy a house. You can do it. You make that median income or better, then perhaps this is something you could do, and then you have a cash emergency fund set aside. That never hurts anything, right? So that is what that looks like if you did a 2-1 buy down. So let's assume that maybe that's just not quite enough. Maybe we don't like a 2-1 buy down. Maybe we want something a little bit more permanent. What does that look like? Let's take a look at that. So maybe a seller, maybe the $500,000 with a 2-1 buy down, or maybe you could squeak by with a little bit lower price and the seller's willing to contribute, but maybe that 2-1 buy down makes you uncomfortable. And it could, and it's not the right fit for everybody. So what if we were to split the difference? We know that to the full affordability index, making it come close to 100 for buyers would mean coming down to a price of $435. What if we were to split the difference? What if we set a sale price of $465,000? You're doing a 5% down payment, and we asked for a permanent rate buy down. Now, with a permanent buy down, you buy points, and there's a limit to what you can actually buy, and usually it's around 3 points. So if we were to do that on this loan, it would drop around 0.75, which gets us to a rate of 5.8. That still sounds a lot better than 6.55. So if we are doing that, what does that look like in terms of how you make that happen? So the cost to do that buy down is approximately $15,000. So you could ask for a credit from the seller, negotiate that in at this sale price, and say we want you to pay $15,000 towards our rate buy down to get us to a lower rate that we feel good about. So what does this look like if we were to do that? So the calculation, again, that brings us to a $3276.04 payment with your PMI every month. So it's close to that affordability index. Again, applying that rule of a buyer can afford 87%. So how do we get it to 100? We try to account for that 13% difference. So that is what brings us to $3276.04. So again, is it perfect? This whole thing perfect? It isn't. But at the end of the day, the goal here is to get everybody to think about how we can make some movement in the market today. And sellers, this is especially important for you as well. And I say this is especially important to sellers as well because without buyers, I will remind you, you will have nobody to buy your house, especially if you need to make a move. And everybody's got goals and things that they need to try to achieve. But I think we all have to work together, and we really need to think about this strategically. Sellers' pricing strategy is more important now than ever. The price you're actually competing with is yesterday's price drop. I'm seeing it with my own listings right now where we see properties that are dropping their prices like crazy. Where we started, our listing price was with the market at that time, but that is how quickly things have changed as more inventory has hit the market. So there's a lot more desperation out there. So I would say it's time to be smart. Don't think of this with a head full of ego that maybe other agents have told you that your house could sell for a lot more than what an agent is who's looking at the data is telling you it could sell for. Oftentimes those marketing pieces are structured that way to get a conversation with you. They might take your business at that amount, but then they're going to be racing to the bottom just like everybody else is. It is so much better to assess the market where it's at today. There's no room right now in this market for wishful thinking. And buyers, it's tough out there, but if you are strategic and you look for the right house, you work with a lender who is cost effective, because yes, you should be shopping for a lender. That is so important right now. Absolutely shop for a lender and see where you can find the best deal for yourself. Shop for home insurance to get yourself the best rate. Bundle it with your car insurance to get the best deal possible. All those little things are going to add up. And so some of these things might be useful to you and they might help, but I think if we all take this approach of being strategic and being understanding of where each other's coming from, I think we'll be able to make some movement in this market. I'm Jennifer Scherter. I'm a real estate agent and a real estate expert in Canby, serving the South Clackamas County and North Willamette Valley areas. So check out my other videos. I love to talk data, numbers, and strategy, and also what's going on in this area, and I hope to see you in the next video.